Audio check, testing the audio. Audio check. If you are on YouTube or Facebook, either one, you wouldn't mind putting something in the chat letting me know that you can hear me. I appreciate that. Just doing an audio check here, making sure that we're good to go. Audio check, just testing the audio. Okay, great. Thank you, Kim. Thank you, Henry. All right, perfect. Looks like we're good to go. Thank you very much. Must have a little bit of a delay going on, but that's okay. We're going to get started right at the top of the hour, about 10 minutes out from our start time. So if you'd like, get a beverage, hot or cold, is fine. If you get a hot beverage, please bear in mind, as always, the lessons we learned from McDonald's long ago. Not too hot. Okay. Hi, Tawana. Thank you. Tea, water, coffee, beverage of your choice, I highly recommend. Again, we'll get started here right at the top of the hour, about 10 minutes to start time. Just want to make sure that all of our tech is working, everything's good. It looks like everyone can hear me, so that's great. Everyone here a first timer? Do we have any repeat offenders or listeners or customers, depending on your status, let's say? Also, we tend to have people from all over the country. Do we have anybody as far away as Hawaii or Alaska on today's event? We have had many people from those two states, as it turns out. I believe in Hawaii it's still the afternoon. Lori's a first timer. Welcome, Lori. Paula, also first timer from South Carolina. Welcome, Paula. Laura's here for the first time. Glad to have you. Yeah, it looks like mostly first-time viewers. That's usually how it goes. Once you've seen this, if you need to see it again, then I guess I didn't do a superb job. Although we do have people from time to time who attend more than once. Hi, James from Pennsylvania. Glad to have you. Hi, Cheryl, Yvonne. Lots of first-timers. Maryland. Kim from Maryland. Ooh, there we go. Coming in from the south, starting to head west. New Orleans. Hi, Terry. Again, we're going to get started here in about 7 minutes. If you just joined us, I see that we have people consistently joining in here. So if you're just joining us, you want to grab a cup of coffee, a tea, water, maybe a something more fun if that's your proclivity. Hi, Judy from Georgia. Rich in Massachusetts. I had one lady say a few weeks ago that she had a bottle of bubbly. I didn't notice that she said any questions at the end in the Q&A, so I hope she made it through. Hi, Carla from Wisconsin. Okay, good. A couple of folks from Florida. Glad to have you. Hi, Pat, also from Florida. Glad to have you. A few people from Florida here. Step away for just a second and get some tea, I think. I think I'm going to do a hot tea. I've yawned just too many times. So apparently I'm a little bit on the tired side, so I'm going to go grab some tea. I encourage you to do the same. We'll get started again right at the top of the hour. Hang tight. Okay, thanks for excusing me for half a second. Got my green tea here, so I should be good to go. Oh, of course I forgot my, I want to just put a hot tea bag. And I'm also not going to chug it, so if anyone here is a green tea drinker, you know, as I know, that in about 5 minutes, this is not going to, this is going to be horrible. So, well, maybe I can drink it down just enough. Get the tea bag out. All right. Out of the water at least. Okay, we're going to get started here in just a minute. I see our numbers are looking pretty good. We are expecting a few more people, and so I want to give them a chance to get in. We know that you got the emails. Did anyone get the text messages? Everybody get the text messages. Are we good there? Let me just check with my tech team real quick, make sure all the text notifications went out. While we're doing some final checks before we get started, grab a water or coffee or tea if you like. We'll get going here in just a second. All right. Lots of people got the text. Okay, so I think we're good. Well, I'm not going to drink it fast enough, and green tea bitter is no good. Okay. Welcome, everyone. My name's Kyle McCauley. I'm one of the national presenters here at Einstein Retirement Workshops, and you are in attendance to our most popular presentation that we do, and this is our Social Security Filing Strategies Workshop. This presentation we have conducted all over the country in face-to-face venues where we would have seen you in a community center, a library, a university, that sort of thing. But now since the advent of COVID and all of the travel restrictions and everything that nicely brought to us, we are now very honored to continue to provide this workshop to you in this live stream format, and we're honored that you're here. Our agenda for today, we're going to spend a little more than an hour on the topic of Social Security. At the end of that hour time together, we will discuss how you can get access to your free copy of our Social Security filing workbook. This is a physical copy of the workbook. It's something that we mail to you, and so we'll talk about right at the end of the presentation how you can request that. Also at the end of the presentation, we'll go right into a Q&A portion of our time together. The Q&A portion of our time is going to be your questions typed into the chat. If you were here early enough to see, I was selecting people's names and they were saying where they were from and that sort of thing. And so I will do that during the Q&A. So save your questions till the end. When we get into that, I'll be able to tap your question and then start answering those here right at the end of the presentation time. My name's Kyle McCauley, as I mentioned a minute ago, and I am the managing partner of City Center Financial. I share that with you so that you understand that my perspective when I do this workshop is as the managing partner of a retirement planning firm. As a retirement planning firm, we obviously help people make Social Security filing decisions every day within the context of their retirement planning needs. And so when I do this presentation, I'm often thinking about scenarios and situations like many of you are, I'm sure, to experience in the various things that we'll discuss this evening. I'm also a chartered retirement planning counselor, an accredited portfolio management advisor, and also, as well as every other member of our team, a national Social Security advisor certified professional. The purpose of our presentation today is not to sign you up for Social Security. We are not affiliated with, nor are we employed by the Social Security Administration. Our job today is to share with you our experience and give you some good advice about things that we think will be helpful to you as you're thinking about how to file for your benefits. We're able to give you that advice as a registered investment advisor. City Center Advisors is our firm. Okay, what does Social Security mean? Why are all of you here? Well, 10,000 baby boomers are turning 65 every single day, roughly speaking, working out to about 3.64 million new folks qualifying for a combination of Social Security and Medicare benefits on an annual basis, and that's expected to continue yet for another 13 years. And so what that highlights for us, and why Social Security is such a hot topic, is because a lot of folks who used to pay dollars into this system are now no longer paying their FICA taxes into the system. They're actually drawing dollars out of the system. And so it brings up issues and concerns, things like, hey, that's a lot of taxes that used to be paid in. Now those dollars are coming out. Is there something going to be left for me? And so issues of insolvency obviously become a big concern, and we'll talk about that. 65% of middle-income Americans derive more than 50% of their retirement income from their Social Security benefits. Now, that stat is true in lots of cases. The obvious one is if you haven't done maybe a great job of saving other forms of retirement income, Social Security is obviously going to be a very big component of your retirement income planning strategies and needs. Even if you have, though, saved a good amount of dollars into, say, a 401k or a brokerage account or IRAs or accumulating pensions or other types of savings that you may have, even for you, many of you will generate still more than 50% of your retirement income from Social Security once those benefits are triggered. It is not uncommon for us to see a married couple between the two of you to have benefits exceeding $60,000 and $70,000 a year. And so not only are the benefits here, which I'm sure that many of you have heard at some point in your life, don't plan on Social Security, it's going bankrupt. Okay, has anybody heard that? Probably. I've done this live enough that if I asked for a show of hands, many, if not all of you, would raise your hand, except for those of you who don't raise your hand to anything. You know who you are. Okay, so besides that group, most of you have heard that. Don't plan on it. But the benefits are still here, and in many cases, the amount of dollars that you could be getting are quite sizable. Since 1985, American corporations have eliminated more than 84,000 pensions, which has enhanced the need and the value of Social Security as a backbone to a retirement plan. In addition to that, we've also seen pensions obviously being frozen. We've seen pensions be reduced even after they've been started, unfortunately. And so there again, it has just simply enhanced the value of having that Social Security benefit. Now today, 46% of Americans pass away with less than $10,000 to their name. We highlight that statistic just from my tech team. I'm getting I see somebody on YouTube and somebody on that we're getting bad audio. Let me try to switch it to that. I don't know if that's going to be any better, but please let me know if that's any better. Okay, we're going to just do we're going to do a quick audio check before I keep going here. Making sure the audio is good. Is audio good? Okay, all right. Tech team says audio is good. If the audio is bad, consider refreshing the page. It could be on your end. I'm sorry for that. I don't know if the audio's better or worse now after I did that. Hold on, tech team is sending me messages. Okay, all right, so we're gonna keep going. Some people said it was always fine. Okay, very good. Okay, 46% of Americans today pass away with less than $10,000 to their name. That statistic is there to highlight one of the key important features of your Social Security benefits. Now, the key important feature is when you frame in your Social Security check into your retirement income plan, what does it mean to you? How should you think about these dollars? Well, Consider this. You insure all the important financial things in your life. For example, do you insure your house? Yeah, right? You get homeowner's insurance. Or if you're a renter, you get renter's insurance. How about your car? Sure. Your health? Right, yeah, definitely. Do you insure your retirement? The answer for most of you, if not all of you, is yes. Social Security, when you frame it in properly and you think about what do these benefits mean to me in my retirement planning, the best way to consider them is as retirement income insurance, or you could say longevity insurance. Why would we frame it in like that? Well, these dollars pay to you so long as you're still living. So even if you're that person passing away with less than $10,000 to your name, even if you're totally broke, so long as you're still living and you qualified for a Social Security benefit, those payments are still coming to you. So there again, we'd refer to that as retirement income insurance or longevity insurance. Longevity insurance might be kind of important these days. People are living a lot longer than they ever expected to. A married couple today, age 65, gentlemen, you have a 50% chance of living to 92. Ladies, you have a 50% chance of living to 97. Now you say, well, gosh, maybe that's true, but my health's not so good. Well, okay, don't count yourself out yet. My granddaddy had 4 heart attacks and 3 bypass surgeries before the age of 75. He just passed away last year in December, not COVID, just old age. He was 92. If you'd asked him in his 80s, you think you lived to 92, he would have smiled and said, I don't think so. Okay? Because, 4 heart attacks, 3 bypass surgeries, it just, the odds were not in his favor. But medical technology, and frankly, my granny, he made it all the way to 92. Now she's still living. She's turned 92 this year herself, and so she's still cruising along. I'm sorry, 91. I don't know, maybe you don't care, but she's 2 years younger than him, so 91. Okay, I don't know if you can live as long as this gal, Kane Tanaka. 118 years of age. She turns 119 in January. We'll see. And from Japan. Of the last 5 oldest living people, 4 of them were from Japan. I just want to highlight that for you in case you're thinking about doing any relocating. You might want to consider Japan. Okay. Here's what we're going to focus on. How's your benefit work? How is it calculated? Strategies for those of you who are married. Options for those of you who are divorced. Options for those of you who are widowed. And if you fall asleep somewhere in the middle, please do wake up in time for taxes. Now, there are some of you who are single who are going, hey, wait a second, what about me? I'm single. Look, you have a bigger tax issue than maybe you realize. The tax portion is going to be very helpful to you and very meaningful to you. Married couples get this wonderful thing called a married filing jointly tax filing situation. As a single person, that kind of flexibility is not available to you. You want to be here for the tax portion of our time together. Plus, how your benefit works and calculated is pretty good. And I tell a few jokes. Hopefully you find them funny. Okay, basics of how your Social Security benefit works. If you do not know if you qualify for a benefit, the requirement is 40 credits. The way you can easily find out if you have credits is to log into ssa.gov. ssa.gov. Social Security Administration.gov, okay? But don't type Social Security Administration, just ssa.gov. On ssa.gov, there's this My Social Security tab. You can click right into that. If you don't already have a profile, you can create one. Pretty easy to do, not hard at all. I did a podcast on it because I didn't want them to mail out statements to 20-year-olds, and I was trying to encourage everyone to log in and click the button that says, don't mail me a statement. Social Security has enough problems already. We don't need to mail out statements to everyone. Okay, unless you like paper, we won't hold that against you. All right, in that login, when you first log into ssa.gov, you'll have green bars that go right across. If there's enough green bars, it'll give you a green check mark. That means you have your 40 credits. 40 credits roughly works out to 10 years worth of work. Not roughly, exactly. And so 10 years worth of work. It doesn't take much to earn a credit. You need $1,470 earned in a calendar quarter to get a credit. Once you have qualified for a benefit, the way that your benefit is calculated is by using the highest 35 years of indexed earnings. Not the most recent 35 years, not the most consecutive 35 years. The highest 35 years, no matter when those years occurred, and after they've been indexed for inflation. In the Social Security filing workbook that we are going to send to you, again, we'll talk about how to get that at the end, you will have an indexing table. That indexing table, you can go to your Social Security statement, and on your statement on page 3, you would see all the years of earnings that you have, how much you've paid in FICA taxes for your Social Security benefit. You can take those dollars, plug them over into an indexing table, and see what they're worth in today's dollars when Social Security calculates your benefit. An example of this would be, let's say you earned $20,000 in 1980. If you want to know what those dollars are worth in your benefit calculation, you'd plug that into your indexing table. You'd see that you need to multiply 20,000 by 4 and change, meaning $20,000 earned in 1980 is worth a little more than $80,000 in your benefit calculation. In order to increase your benefit calculation with your work, you must replace a lower income year in the past. But not lower dollar for dollar, lower after those dollars have been indexed for inflation. So, if your lowest income year in the past is $20,000 in 1980 and you're earning $60,000 this year, your earnings this year are not increasing Social Security. They're not decreasing Social Security, but they're just not giving you an increase for the future. Some people do mistakenly assume that just because they're working, they are necessarily increasing their benefit for the future. Not so. You must replace a lower income year in the past. Now, on the flip side of that, what happens if you don't have all 35 years? Let's say you only have 25 years. Well, what Social Security does is they take your 25 years, index them for inflation, and then add 10 zeros into that benefit calculation number. So any additional work that you're doing today is replacing a zero and should have a pretty good size impact in terms of increasing your benefit down the road. Two main provisions that I want to focus on here that affect the largest percentage of people, and that is what could reduce your Social Security benefit. The thing that is most likely to affect you potentially in terms of reducing your Social Security would be if you have what is called a non-covered pension. A non-covered pension is a pension that you earn from an employer that is going to pay you the pension, but you're not also paying FICA taxes while you're working there. This mostly affects government employees. A fair number of teachers' pensions are like this. Local municipalities, especially firefighter pensions and police pensions, act like this. So you just got to be aware that if you did not pay FICA taxes, this is a non-covered pension. If you have a non-covered pension and you also have other work that qualified you for Social Security, your pension cannot reduce Social Security to zero. But depending on how many years of substantial earnings you have, your Social Security will be reduced. And the provision you're dealing with is the WEP, or the windfall elimination provision. Calculations are in your workbook. I don't have them all memorized. Okay, the government pension offset's a little easier to calculate, but is a little more painful. The government pension offset applies in a scenario where the Social Security benefit you're applying for is not your own, it's actually a spousal benefit, either ex-spousal or spousal. When you claim your pension, 2/3 of whatever that pension is counts against the Social Security benefit, and if that is a negative number or 0, then you get nothing. Okay, so it can reduce it down to nothing. I think you know this, but if you don't, you've paid a lot of money into Social Security. 6.2% of your pay over the last 10, 20, 30, 40, however many years you've been working, has been going into the Social Security system. Your employer has matched that for a total of 12.4% of your pay. Unless you were self-employed, then you got to pay both. Now, unfortunately, the way the system works is not as though you have an account somewhere with 12.4% of your pay in it. I think if you could imagine an account with 12.4% of your pay in it over all the years you've been working, that might be a tidy sum of dollars, especially if you happen to even earn a little bit of interest on it. But that's not how the system works. The way the system works is that dollars that flow into the system today are leaving the system today to pay current recipients. It's a pay-as-we-go system. That also means that we are in the red. We've been in the red since 2010. That was the first time since 1983. And we're fully funded through 2035. In 2036, we're only funded for roughly 75 cents on the dollar thereafter. Here's what this does not mean. In 2036, they are not going to cut your benefits by 25%. How do I know? Well, governments usually don't like riots in the streets, especially if all it takes is a little money. Okay, we've printed money before. I think we can pull it off again. Okay, now current federal law doesn't allow them to just print money to solve this problem. So what they'll do is they'll solve it actuarially. You know that they do this because if you think about it, all of your parents had a full retirement age of 65. Now, the oldest of you have a full retirement age of 66. The youngest of you have a full retirement age of 67. And then there's a bunch of you, maybe most of you, have a full retirement age of 66 and some number of months. 2 months, 4 months, 6 months, 8 months, 10 months, whatever your date of birth happens to be. So, what is that process that moved us from 65 to 66 to 70? That was a grandfathering in that got you in this special group here where your full retirement age was pushed up. It effectively reduced your benefits, okay? But they didn't say, no, you can't receive what's on your statement. They just say you can't receive it right away. You got to wait a little longer. And so that's what that does. They will do that to your children and grandchildren, and that's how they'll fix the system, rest assured. Always the possibility that they increase payroll taxes, but as you can imagine, that's not the popular option. Pushing a minimum filing from 62 to 64, 65, pushing full retirement age all the way up to 70, these options are more popular. Once you hit 55, you can pretty well count on the benefits that you're expecting to receive. Current federal law says that they cannot change those benefits. So, let's talk about how your benefits work, how they're calculated based on when you file. Now, I know that many of you do have that full retirement age of 66 and some number of months. Some of you are at 67. But just for ease of explanation, we're going to assume for a minute that everybody has a full retirement age of 66. If you file for benefits at your full retirement age, you are eligible to receive 100% of what is known as your primary insurance amount, PIA. That primary insurance amount is estimated for you on the very front page of your Social Security statement. That big bold number in the upper right corner, that is your estimated primary insurance amount. If that number says $2,000 and you file at your full retirement age, you would expect to receive $2,000, 100% of that. If you file early, you are allowed. You can file as early as the age of 62, but it is a reduced benefit. Your benefit could be reduced down by 25%, taking that $2,000 down to $1,500. If you would like to delay past your full retirement age, you can do that indefinitely. But you're only rewarded till age 70. Okay? They will give you an 8%, what is known as a delayed retirement credit for delaying to as late as age 70, turning $2,000 into 132% or 2,640. The delays and filing early happen, and those increases and decreases happen on a monthly schedule, not annual. We tend to talk about them annually, but it's actually a monthly change. There are actually three distinct benefits you can file for. The first is the retired workers benefit. This is the benefit that you're entitled to based upon your own work history. The spousal benefit is the benefit that you're entitled to based upon a spouse or ex-spouse's work history. And then widow or survivor benefits would be benefits that you're entitled to based upon a deceased spouse's work history or a deceased ex-spouse's work history. The last time Social Security law was changed was October 2015. In October of 2015, they basically took away all the fun stuff, okay? So if you've heard about things like file and suspend, get a lump sum check, all that kind of crazy stuff, that's all gone, okay? There is one little exception that applies to a rapidly diminishing group. This group is folks who have not yet filed for a Social Security benefit, are born before January 2nd of 1954, and have access to a spousal or ex-spousal benefit. If you're in that group and those things apply to you, you can file a restricted application, receive spousal benefits only, and delay your own to a later date. To do that, you must be born before January 2nd of 1954. So many of you, probably most of you, are much too young. Let me be the first to tell you that if you haven't heard that in a while. Let me tell you right now, okay? You're much too young to do this any longer, okay? But some of you that will apply to. Okay, for those as well as everyone else, there's just a couple of things to keep in mind in terms of filing strategies, okay? If you file for a Social Security benefit, you can tell Social Security to stop paying you at any time for any reason, and they'll stop. It's called a suspension, okay? Suspending benefits. Now, if you suspend your benefits and you're younger than 70, from the point at which you suspend until as late as age 70 when you file again, you'll earn any delayed retirement credits you're entitled to. So if you filed for benefits and said, I kind of wish I could increase it, no problem, suspend, you'll get some increases and then you can file again down the road. Now, if you would like and you say, gosh, I really wish I hadn't filed, and you're still within the first 365 days from when you filed, you can do what is called a rescinding of your application. Rescinding your application will tell Social Security, stop paying me. I want to reset my benefits as though I never filed. If you're within the first 365 days, they'll say, no problem, just pay us back any dollars you've received from us so far. As long as you do that, they'll reset your benefit as though you never filed. It can only be done one time. Just checking on my tech team there. Okay, now, why would you ever do that? Let's say you were laid off from your job. You figure, gosh, I guess I'm unemployed. But then a few months go by and your employer comes back and says, hey, we have your job back. And you say, well, I wasn't planning to retire, so fine, I'll come back to work. So now you're reemployed, you have Social Security, you don't need the Social Security. What could you do? Well, you could either rescind your application or just simply suspend benefits. Let's talk about spousal benefits. In order to qualify for a spousal benefit, you need to have been married for at least 1 year. The primary worker, the spouse that you're filing off of, must have filed their benefits, called deemed filing. If you have your own benefit, and it is more than 50% or half of your spouse's primary insurance amount, just forget about the spousal benefit. You're only dealing with your own. If I have a $1,200 a month benefit, my wife has a $2,000 a month benefit, she files for hers, and I think, gosh, hers is more than mine, I want to file a spousal. Well, half of $2,000 is only $1,000. My $1,200 is all I'm dealing with. I don't get mine plus part of hers, none of that stuff. Now, it's 50% of my spouse's primary insurance amount, not the benefit amount that's being calculated. So if John's primary insurance amount is $2,000, Jane is eligible for half of that at her full retirement age, or $1,000. Here's why that's important. If John files at 62, he turns a 2,000 into 1,500, 75%. As long as Jane waits till 66, though, her full retirement age, she still gets the full $1,000. So John's getting $1,500, but she's getting $1,000 as a spousal benefit. It's 50% of the primary insurance amount based on Jane's age, not what John is receiving. Now, the reverse of that is also true. If John delays till 70 and is getting $2,640, Jane still only gets $1,000. There are no delayed retirement credits on spousal benefits. So spouses, there's nothing in it for you to delay past full retirement age, okay? Unless your spouse wants to delay till 70 and you're stuck because maybe you're the same age. Other than that, you want to file no later than full retirement age. Now, spousal benefits can be filed early as 62, but if you do that, the reduction is worse, okay? If I have $1,000 a month as my own benefit, I get $750 if I file at 62. But if it's not my own, it's a spousal, I don't get $750, I only get $700. So spousal benefits reduce on a faster schedule when filing early. Survivor benefits. Married couples, when one of you passes away, only one benefit remains. It's always the higher of the two. So if my wife has a $2,000 benefit and I have $1,000, if I predecease her, I take my $1,000 with me. She keeps her $2,000. If she predeceases me, I say goodbye to my $1,000. I keep her $2,000. Only one benefit remains. It's always the higher of the two. The only caveat to this is the 82.5% rule, which says that if my wife had filed early at 62 and she predeceases me, she's getting $1,500 a month. The 82.5% rule would bump that $1,500 to $1,650. Two most common mistakes we see married couples make. The first one has to do with the framing of Social Security. Remember, Social Security framed into your retirement plans is best framed in as retirement income insurance, or there again we could say longevity insurance. So if anyone is going to be delaying their benefits, it's going to be the higher wage earner because your benefit is the one that lasts when one of you passes away. It's the survivor benefit check. Maybe that's not too big a deal if both of you pass away in your 90s. But what if one of you passes away, God forbid, in your 70s, and then the other lives into the 90s? Could be 20 years of one Social Security check. And so, generally, we want that check to be as high as it can reasonably be. That means if anyone's delaying, it's that higher wage earner. On the flip side of this, it almost never works out for both spouses to delay past full retirement age. Again, generally speaking, one spouse is going to want to claim early to some degree or another, and one spouse is going to delay to some degree or another. This really comes from our experience, and we've done more than a couple thousand Social Security plans already this year, and so this comes from our experience in putting these analyses together for folks. It just almost never works out that both of you are advised to delay past full retirement age. Okay, let's talk about divorced spouse benefits. In order to qualify for a divorced spouse benefit, you need to have been married for 10 years in a row to the same person. Okay, married 5 years, divorced, remarried, even to the same person, 7 years, divorced. 5 plus 7 does not equal 12. One of those two stints has to be at least 10 years. So I know you didn't come on here for marriage counseling, but if you needed a reason to hang on, there you go. All right. You may not be currently married. Okay, we're having some audio issues here. Let's see if I can. I might do this a little bit differently. My normal system is down. I apologize for that. Just want to make sure everybody can hear me. Can everybody hear me okay? Okay, all right. Yeah, I have sort of a weird setup going on, so give me 1 second. I just need to load a different view. We're going to try this. I couldn't get my normal device to work, unfortunately, which is a little troublesome. But we're going to try it this way. I think I can pull it off. Hang tight for 1 second. I know you can see my face and all that good stuff. Okay, we're going to... Okay. And then I need to add the share screen here. Okay, let's try this. Okay, all right. Well, I don't know about the whole seeing my face thing, but here we go. So I think we have, you can see the screen, so let's try this. Okay, we were talking divorced spouse benefits, so I think you can see that there. And we're going to go here. Okay, all right, so technology, love it, hate it, all of that stuff. Okay, so here's the issue with divorced spouse benefits, okay? So divorced spouse benefits, if you currently are able to get a benefit for yourself, what is this that's kind of in my face here? Hold on. Let's move that out of the way. Okay. All right. Well, this is exciting. Never done it like this before. Congratulations to all of you. You get to see me troubleshoot live in action. So there we go. All right. Okay. So you may not be currently married. So if you've remarried, okay, you have a marriage that lasted more than 10 years, you're thinking about filing for ex-spousal benefits, but you're remarried, the only benefits you can file for at that point are either your own or your new spousal benefits. Those are the ones that you're entitled to. Okay, same benefit amounts in terms of extra penalties for filing early, as well as no increases for delaying, apply to these ex-spousal benefits, as did also the spousal benefits, okay? Independently entitled, what that's referring to is if you are married, you have to wait for your spouse to file their benefit in order for you to file your own. But if you've been divorced for at least 2 years, you can file those divorced spouse benefits whether your spouse has filed or not. So independently of whatever they do, you can file on your own timetable. Okay. If you were born before January 2nd of 1954 and your spouse and you have access to an ex-spousal benefit and you've not yet filed for a benefit yet, the divorced spouse, the restricted application could be particularly advantageous to you. Okay, one goofy thing about divorced spouse benefits. If you are claiming a divorced spouse benefit and you have a marriage that lasted more than 10 years and that person is younger than 62, you have to wait till they hit 62, but you could start, say, with your own benefit at 62, and then when they hit 62, you can then switch and file based on their work history. If that happens again, because you managed to fit in another 10-year marriage like that, you could do it again. So as many 10-year marriages as you can fit into your lifetime and conjure up that scenario, you can do it. Okay, common questions we hear from those who are divorced. I'm divorced. I have a marriage that lasted more than 10 years. They're going to file off of my work history. Is that going to affect me in some way? No, it will not. I'm divorced. my ex is going to file off of me. I've also remarried, and my new spouse is going to file off of me. Are their benefits going to affect each other? No, they will not. I'm divorced, and I've managed to fit a few 10-year marriages in my lifetime, and they are going to file off of me. My new spouse is going to file off of me, and I'm going to die young. No, just kidding. Okay. No, yes, all of these people, so long as the marriage has lasted more than 10 years, they could file off of you. The new spouse could, no problem. But yeah, in fact, if you do die young, they can all file widow benefits as well. So that is allowed. Now, another situation is I'm divorced. I'm going to file on my ex's work history. Are they going to know that I've done that? No, they are not. Okay, so the only way that someone would know that you filed on their work history is if you tell them, right? You'd have to let them know that you did that. Okay, let's talk about widow benefits. Widows are a special group. They're the only group who can file for benefits as early as the age of 60. If you file for benefits, if you were widowed prior to 60 and you want to file for benefits at 60 on your widow benefits, you need to have remained unmarried until the age of 60. If you hit 60 and you remarried before then, the widow benefits are gone. Now, the very first workshop, one of the first workshops, I actually was talking to my wife the other day, and I was sitting down. We were outside enjoying some dinner together, and I was telling her about this for some reason. I can't remember. And I realized that I've done hundreds of these now, and I've said week after week, the very first workshop, it wasn't the very first one. It was one of the first ones. I think it was like number 5. It was the very first one I did in Port Huron, Michigan. So that part's true. But in any case, I realized, gosh, I've been saying that wrong all this time. And I'm kind of a stickler for the truth. So it wasn't the very first one, but it was one of the first workshops I ever did. A gal in the back raised her hand during the Q&A and said, so it sounds like I need to delay the wedding. Of course, all the room laughed, and I chuckled, and I said, well, tell me more. Well, she's 59 years of age. She was slated to be married in September. This was a June workshop, but her birthday was not until March of the following year. She didn't turn 60 until next year, March. So if she remarried in September, she had a nice widow benefit, just under $2,000 a month that she was entitled to. That would have been gone, totally gone. She had to wait 2 years to either file her own or her new spousal benefit. The new spousal benefit that she would file to was the higher of the two, and it was just under $1,500. So how great is this? She's got to wait 2 years to file and get $500 a month less. So yeah, in her case, we recommended that she delay the wedding. Now, she did go to her priest. I think it's funny. I'm a religious person. You can decide how you feel about it. She went to her priest and said, so can we just do the religious part of the ceremony and sign stuff later? And her priest said, no. I said, there's another priest. Someone will do this for you, I'm sure. But she's very devout. The wedding was delayed. Before we move on, last bullet point here. You need to have been married a minimum of 9 months prior to the death of your spouse in order for those widow benefits to retain. Now, this provision is here specifically to prevent deathbed marriages. It is not there to hurt people, okay? Specifically and only there to prevent the deathbed marriage. So, only real life example run across to with this. Gal was married later in life. Husband was in the armed forces. He was shipped overseas, killed in action. They'd been married just under 6 months. She assumed widow benefits not available because of the 9-month rule. Although it wasn't as though he had a terminal illness or something like that. It was just that he died in serving the country. So we submitted proper documentation. Widow benefits were reopened. Another case study. Widows have the most options in terms of how they can file, and this case study does a good job of highlighting that. So John never elected for benefits. He died at the age of 64. We never met John. Jane attended one of our workshops, and we met her at the age of 60. She was 59 when John died, but we met her at 60, and she's trying to figure out what in the heck should I do about these widow benefits. I hear I'm entitled. Now, Jane does have her own benefit on her work history, estimated amount of, I can't see it with my comment there, 1,197, I think, at the age of 62. There you go. Thanks, tech team. They're trying to be helpful and keep us all engaged. So that's good, but I couldn't read the screen there. Okay, so 1,197 is the amount. Now, what should Jane do? Because she's got some options here. Now, one option for Jane is that she could file for those widow benefits right away if she's 60 years old. So if she does that, you can see there with the file without thinking, she could just file for $1,537 a month, John's reduced widow benefit to her age 60. And if she collects that from 60 until age 85, she would receive over her lifetime about $461,000. Now, if Jane simply knows that the option is available to her, she can switch to her own maximized benefit as late as age 70. So you look down to strategy 2 there on the bottom. Okay? Strategy 2 down there on the bottom says Jane could take her own benefit at age 60, $1,537 a month, and she could increase that from 60 to age 70, so she files the widow. Her own benefit earns delayed retirement credits all the way up till age 70 and is now worth $2,108 a month. So that over her lifetime is more than $100,000 more in benefits simply for understanding her options. Now, the real Jane is actually not able to do that strategy because she doesn't want to make any big life changes. John recently deceased. She's going to start actually with her own benefit first. If she does it like that and she files for her own benefit first, what you can see here is that she collects $1,197 at 62. So she's going to work 2 more years. And because of the earnings test, she can't file for the widow benefits. It just doesn't make sense. We'll talk about the earnings test more in a minute. But you see here, 1,197 is what she starts with on her own, and then switches to the maximized widow benefit at 67, 2,150 from John. That's also $70,000 more over her lifetime. There again, just for understanding her options. So Jane has lots of options. Widows have lots of options in terms of how they can file. Now, I'm often struck by this, basically every time I do it. You know, $400,000, $500,000. This is a single person, no inflation adjustments. It's not uncommon, excuse me, for us to see single people with lifetime benefits over $1 million. Married couples, $1 million is easy. Many times over $2 million of lifetime benefits. So not only, excuse me, not only are these benefits here, swallowed some tea badly, but they're quite good, and also it's worth doing planning. For many of us, this Social Security decision may be one of the single biggest financial decisions that we ever make. Now, I'm probably preaching to the choir because you're here, but I'll preach anyway. You should do planning, right? You need to do the planning to maximize what you get out of this system. Okay, let's talk about the earnings test. So why was it not advisable for Jane, who's going to work a couple more years, why was it not a good idea for Jane to file for those benefits right away? It's because of the earnings test. So Jane's still working and she has not yet reached her full retirement age. Once you hit your full retirement age, you can work and have Social Security at the same time, and no earnings test. You got to pay taxes, but it's not a problem. There's no reduction of benefits or anything like that. The only time a reduction of benefits is going to kick in is in the scenario where you file earlier than your full retirement age, and you have earned income. W-2, 1099, self-employment. If you have that kind of income and you file for Social Security prior to reaching your full retirement age, Social Security asks, how much income do you make? If that number is more than 18,960, so the left side of the page there, 18,960, they don't care. But the minute you go above 18,960 of earned income, Social Security starts caring. How much do they care? They care about $1 for every 2 that you earn above that limit. Let's take an example. Let's say you have an income of $58,960. $58,960, you take off the 18,960, and that leaves you with 40,000 above the limit. Social Security cares about 1 for every 2 above the limit. So you are ineligible to receive $20,000. We chop it in half. $20,000 from Social Security is what you are ineligible to receive. If you have a Social Security check that you file for that's $2,000 a month, $2,000 goes into $20,000 10 times, meaning you will not receive a check in January, February, March, April, May, June, July, August, September, October. Then you'll receive a $2,000 check in November and a $2,000 check in December. Some people mistakenly assume that if you go above these limits, they'll reduce what you receive, but you'll still get a check all year. They simply will not pay you anything until you've paid back what you were ineligible to receive. Okay? Now, in the year that you turn your full retirement age, that's the right side of the page, this almost never applies to anyone, but I'll cover it briefly. Your earnings test goes up to $50,520, and it's a 1 for 3. But it's in the year you turn your full retirement age, but only before you turn your full retirement age. Again, once you hit your full retirement age, you can have any earnings amount, and the earnings test will not apply to you. Let's talk taxes. This is the fun page here. I don't know if you can see that, but this says here that there is a 33-page document that Social Security produces called Publication 915. And this document is produced every year to detail out for you everything that you could possibly want to know about how you'll pay taxes on your Social Security benefits. Why does it take 33 pages? Don't make the libertarian in me come out. It's the government. All right, so yes, a 33-page document is required to tell you everything you could possibly want to know about how you'll be paying taxes on your Social Security benefits. Awesome. Well, there's some complicated stuff in here, but helpful, at least helpful to me. So maybe it's a little tongue-in-cheek. But this page here is the 19-step process. It's a worksheet that details out for you the 19-step process that you must go through to determine how much tax you will owe on your Social Security benefits. Why 19 steps? Well, I think I already covered that. All right, what we're not going to do is go through all 19 steps. What we are going to do is we're going to highlight some things for you that are going to give you a good sense as to how this works and what you should have in mind related to how taxes could affect your Social Security benefits. Line 1 on this worksheet is where you would put your provisional income. Provisional income is 3 things. You need to know your provisional income number, okay? Provisional income is all of your adjusted gross income. That's going to be your capital gains, long and short, interest income, dividend income, earned income, W-2, 1099, K-1 income, rental property income, self-employment income, annuity income, pension income, ordinary income, withdrawals from the 401k, everything. You say, okay, fine, I get that, right? That makes sense. Okay, but that's number 1. Number 2 stings a little. Okay, so your municipal bond interest income counts towards your provisional income number. Okay, tax-free interest. Okay, normally you get tax-free interest to avoid taxes, but unfortunately the IRS found a back-end way to get at it, and they do it by affecting how much tax you owe on Social Security. The third item, and this one's the stinger, 50% of the Social Security benefits that you're receiving count towards the number that determines how much tax you're going to owe on your Social Security benefits. I've done this live enough to hear people shout out things like, hey, that's double dipping and things like that. So, if you're feeling that way, I certainly understand. Okay, if that provisional income number and you are single is more than $25,000, you start paying taxes on Social Security. If it goes above $34,000, you could be paying tax on up to 85% of your benefits. Married couples at $32,000 of provisional income, you start paying tax on Social Security. If you go above $44,000, you could be paying tax on up to 85% of your benefits. The question, of course, is how much tax? Well, this is where it gets a little complicated, unfortunately. So let's take an example. Let's say you're cruising along through retirement, everything's going well. You've got some retirement income coming in from maybe pensions or 401k plus your Social Security, but you're cruising along just fine, right? You're enjoying your retirement, you're having a good time, but you this year would like to enjoy maybe some of your dollars because you've been cooped up for a little while and you'd like to go do some traveling. And so you budget things out and figure out a nice trip. You talk to your friends or your loved one, and you say, hey, I'd like to go on a vacation. You want to go with me? We've been cooped up at home too long. And they say, great, that sounds wonderful. So you start booking things and figuring it out. And then what you figure out is that this trip is going to cost you about $10,000. Okay, so you got to get the money from somewhere. Where are you going to pull $10,000 from? So you survey your accounts, right? You look, okay, well, I got this 401k over here. It's done well. Our market's gone up. My investments have grown. I got it. What did I save all this money for? I saved it for me. I'll pull it from there. So you call up your 401k plan. You say, hello, I'd like to pull $10,000, please. And they say, no problem. And then they ask you a very important question. They say, how much tax would you like to have withheld from this distribution? Oh yeah, taxes, right? Yeah. No problem. Yeah, I knew. Of course, I got to pay taxes. So you go. Maybe you go to your tax return, or you just happen to know, and you're in. Let's say you're in the 12% tax bracket. Okay, so you're in the 12% tax bracket. So you get on the phone with the 401k and say, I'd like to withhold 12%, please. They say, no problem. They withhold the 12%. They send you your dollars, and you get to enjoy your trip. And then next year in March or April, you're punching stuff into TurboTax or Tax Act Online or whatever you're doing, okay? Or you send your stuff to your CPA, and they call you up, or TurboTax is broken. Hey, it says you owe money. You never owe money. You always withhold enough tax. What the heck's going on? Well, unfortunately, TurboTax is not broken. Your CPA is not wrong. You did, in fact, not withhold enough tax. Here's what happened. When you took that $10,000 distribution, you were above these limits. Okay, on the screen here, you're above that. So what happened is you didn't get more money from Social Security, but you did add taxes to your Social Security benefits. So when you take your $10,000 distribution from the 401k, that's taxed at 12%. But you didn't account for the additional $10,000 that became taxable from Social Security. 12% here plus 12% here, you should have withheld 24%. That stings a little, it's no fun, but that is not the bad one. Unfortunately, the bad one is likely to occur to more people than what I would like to see, certainly. But I would think that most retirement planners in my position would also not like to see this. But here's where people are headed. Just did a podcast actually earlier today on this topic of how of how many people pull from their nest egg, their 401k and IRA types of accounts. JP Morgan did a study and they said that 80% of their customers do not pull from their IRA and 401k accounts until they hit their required minimum distribution age. Why is that a problem? Well, imagine that you do the thing that many people do as you get into retirement. You get your spending down, right? Because you don't want to put too much pressure on your portfolio. You did some prudent things. You saved your dollars. You got the money into the 401k accounts. Those accounts have grown. You've invested well. They keep growing. You get your spending down because you don't want to end up with a situation where you run out of money. You want to be able to care for yourself later in life. You don't want to be a burden to your family. And so you get your spending down so you don't have to draw much or maybe anything. Maybe you're like the JP Morgan customers, you're part of that 80% that won't draw anything from their investment accounts. So if that's you, you got a different problem. Problem happens when you hit 72. At the age of 72, you pick up what is known as a required minimum distribution. That required minimum distribution is mandatory. You don't have a choice. You must pull it from your 401k, IRA, 403b, 457, TIA, TSP, all of these types of accounts. If you pull that distribution and that account is quite large, the distribution could be quite large. If it's large enough, also causing additional taxes on Social Security, you may end up in a scenario where, whoops, you're not in the 12% tax bracket anymore. You're in the 22% tax bracket. Now it's not 12 and 12 is 24, it's 22 and 22 is 44. These are the kinds of tax mistakes that you want to avoid, and having a planned income strategy that coordinates Social Security is vital. Let's look at a case study that highlights this. Clients are 64 and 62. They have just over $34,000 in combined Social Security benefits if they file for those benefits early. They're going to start their retirement with $752,000 in their 401k and IRA accounts. They'll earn 6% on those accounts, and they'll need to hit their inflation-adjusted income target of $70,000, increasing by 3% per year to keep up with inflation. They will live to 86 and 89 respectively. There are three groups of you hearing me describe this scenario. The first group of you is saying, okay, these numbers, tweak this one or that one, but yeah, pretty close. Okay, obviously this will be very meaningful to you, so hang with me. Another group of you is looking at this and saying, 752,000? What happened? Didn't they have any kids? Okay, so look, if you're looking at this and saying, gosh, it seems like a lot of savings, I wish I had that much, then look, I need you to listen, because this couple with $752,000 has a running out of money problem, and we're going to show how Social Security can help fix it. Third group of you is saying, yeah, I knew you were going to say they're going to run out of money, Kyle. They didn't save enough. 750, no, they got to keep working. They got to keep going. That's not enough savings. So look, if you're saying only 752, then I need you to pay attention, because this couple with just $752,000 has a tax problem, and we're going to show how a change in their Social Security strategy can help fix it. If this couple files for Social Security early, you see the blue lines there, covering about half of their total income need. The other half of their income need is being met by withdrawals out of their 401k and IRA assets. That's the orange lines there. The red line is the line they need to hit to keep up with inflation and get their income. The amount of the orange line above the red line is the amount that they're paying in taxes. Now, if you look at these various bars here, a few things you should be noticing. Number one, Social Security lags behind real inflation. the inflation line's increasing at a faster pace than those Social Security benefits, and that's correct. Historically, Social Security lags behind real inflation by about 1%. That's because you tend to spend money at the CPI-U index, and Social Security inflates at the CPI-W index. So I know you're all amazed to hear that the CPI-W doesn't grow as quickly as the CPI-U. All right. Also, the amount in taxes, the amount of the orange line above the red line, is not increasing linearly. It's increasing exponentially because of that double taxation process I just described a moment ago. They put so much pressure on their investments that you see there that they eventually run out of money, no more withdrawals out of the IRAs, and that's because they're broke, right? They ran out of dollars 14 years too soon. Actually, before we go to the next slide, the only difference between this slide and the next slide is a change in the Social Security filing strategy. No advanced tax planning being introduced. This couple and many others would benefit greatly from enhanced tax planning, but we're not doing any of that in this scenario. We're just changing the way they file Social Security. The reason why we're focusing only on Social Security is so that you can see the value of optimizing your Social Security decision and just how important that is. If this couple will file for benefits on an optimized schedule, it will mean that they need to take all of their early retirement income from those 401k assets. And you see that there with the orange lines in those early years. Not delaying retirement, just delaying when we file Social Security. Once they file Social Security, their income need is being met much better from Social Security. You see, Social Security is actually technically tax advantageous, so long as you don't have too much other income. So that's the trick. Now you want to have income, so what gives is that you need to manage where those other sources of income are coming from. Now, once they trigger Social Security, their withdrawals from the 401k drop so much that their portfolio lasts the rest of their life. And the amount of taxes in those early years is almost nothing. I don't know if you can see it. There's a little bit of orange above the red, but not much. And it's not uncommon. It would probably be pretty easy for this couple if we did some tax planning, like Roth conversion planning, to get them in a position where they might even pay zero taxes by the time those Social Security benefits are filed for. So tax planning makes a big difference. Social Security optimization makes a big difference, allows their portfolio to last their entire lifetime. If we compare just the taxes, you'll see that in the early years, by optimizing Social Security, that's those blue lines there, they pay a little bit more in taxes in those early years. But look at all the excess tax, the orange lines above the blue lines, all the excess tax being paid simply for filing Social Security early. Once they hit about that 14 years before the end of their plan and they stop paying taxes on Social Security, don't worry, it's not like it's a trick or a good deal. They're broke. Okay, so it's not a good deal at all. All right. If they optimize Social Security, they get $186,000 more out of their benefits. Their portfolio lasts 14 more years. And even though they weren't paying any taxes for 14 years when they don't optimize, they still save $35,000 over their lifetime in tax exposure by optimizing their Social Security strategy. A few things about your Social Security benefit statement. Number one, it is a snapshot in time. No cost of living adjustments applied. It assumes that you work all the way until 62, retire, file immediately, or all the way to full retirement age, retire, file immediately, or all the way until 70, retire, file immediately. Okay, if you retire at 65 but don't take benefits till a later date, your benefit statement might be a little bit off. It's your work history only, no spousal coordination, no widow benefits, no ex-spousal coordination, and then certainly and obviously no advice. So look, after hearing our presentation today, you may or may not feel that you could use a more individualized, specified look at your benefits and how these benefits should be best filed for in your specific situation. Now, when we say in your specific situation, we're talking about the coordination of Social Security into your total retirement income plan picture. Filing for Social Security benefits, I don't know how you feel about it, but I cannot possibly imagine that we should be thinking something like, oh, yeah, let's just file it irregardless of everything else and taxes. Who cares? Okay, you can't think like that. I hope I've made it so that after hearing the presentation today, you can't think that way, because it is so important to optimize your Social Security filing decision within the framework of your total retirement plan, especially optimizing around this issue of taxes. Okay. If you would like to get an analysis from us about this, you may receive that at no cost, free. Okay. We're not going to charge you anything to get this complimentary analysis from us. But this analysis is specified to you, specific to you. It requires a couple of meetings with you to deliver this analysis to you. Okay, so how do we have time to work with you for free to give you a free product? Okay, think about it like this, right? We have been doing this a long time. We provide this analysis and have provided several thousand analyses reports over the last couple of years. And the reason why we're able to do this where we are not charging you is because we view it kind of like a sample, right? So once upon a time, they came briefly and now they're gone again. You could go to Costco and get a sample. Okay, get a sample of different food stuff. It was the only redeeming quality of going to Costco on the weekends, is that you could get a sample. Now, the great thing about a sample is that it lets you try something, and then, but if you like it, they expect that maybe you'll reach over and pull something out of the freezer or off the shelf and take it home with you, buy it. And so we sort of feel that way about this analysis. Okay, we believe that this analysis is a very good sample of the work and the value that we bring to our clients. It is our anticipation that if you get this analysis from us, there's a very good possibility that we may earn the right, or maybe I should say the privilege, or maybe I should even really just say the honor of serving you with other retirement planning or investing needs that you may have. Okay, City Center Financial is my firm. Our firm provides this analysis on behalf of our educational brand, Einstein Retirement Workshops. This analysis is something that we provide to our clients, and we are a fiduciary advisory firm, and so it's something that we're going to treat you in that same regard, with a fiduciary look and providing you the best analysis and the best advice we can about how you should be thinking about these benefits. Okay, if you think an analysis like this, provided from a firm that has the level of experience and the quality that we provide, if you're not sure about our quality, check out our Facebook page and our comments about that. You'll see comments about the workshop and the analysis process, and we get nothing but great reviews as far as I can tell. So we'd encourage you to check that out if you're unsure, but do that, because this is something that we're very proud of, and we're honored to provide it to you if you think it could be helpful. Let me tell you a little bit about what's in it if you decide to get it. First of all, personalized strategies, step by step, telling you exactly when you should file, what's the most optimized way, how much in benefits will you receive. We'll show you a few different options of how you could file so that you can kind of see how that goes. We'll also compare them with a break-even analysis and give you a sense of which benefit is better when, which circumstance provides you the most value based on possibly when you might pass, or when, if there's a big age gap between the two of you or something like that, unique circumstances especially come into play. But also, the thing that I would say really sets our analysis apart, the thing that's going to cause you to say, wow, I'm really glad I did this. I'm glad I decided to get this analysis. The thing that will set it apart and cause you to say that is this portion right here that you're looking at. This is a screen capture of our proprietary Retirement Defender software tool. This software tool we chose to build not because we were excited about getting into software creation, No, we built it because we felt the other software tools out there did not provide the correct level of detailed analysis of taxes and planning that we wanted. In fact, it started out as a spreadsheet, very complicated spreadsheet that I built, and then we finally converted it into software because it's just something that we use with every client. I don't know if you can see it there, but these numbers get pretty specific. When you're dealing with the IRS, you don't mess around. Okay, you need to be specific in your planning. For example, this couple is converting $42,350. It's not uncommon for us to see $42,355.22. Okay, down to that level of granularity. And the reason why that's so important is because there again, when you're maximizing and optimizing your plan, you need to be able to plan at that level of granularity. Also, this couple is able to get a lot of value from it because they're never again taxed on the full 85% of their Social Security benefits if they implement some of these planning strategies. And so this is, again, the part of the analysis that will really set it apart for you and make you really pleased that you got it. We'll also look at the viability of your income plan. Are you at risk for running out of money? Or are you in good shape? If we do something like a Roth conversion strategy, does it make a difference? Does it help? Does it put you in a position to get more tax-free dollars? I think this couple, it's a little small even for me, is getting around $700,000 more tax-free dollars. They have heirs that they want to leave some money to, and so they obviously love that. And so it's just a very important thing. Now, how is this going to look for you? Well, we'll see, right? We'll see how it looks for you. Okay, couple of things by way of disclosure, and then we're going to go right into the Q&A, and we're going to talk about how to get your workbook, okay? Okay, here's the couple of disclosure items. Number one, I mentioned just a moment ago, the analyses are provided by my firm, City Center Financial, and our team are all licensed, certified as National Social Security Advisor certified professionals. Okay, Social Security law is complicated. You can't accidentally become an expert. It is mandatory. Every single one of our team members has that certification. Number three, they're all fiduciary advisors. Okay, we do not have any team members that are not fiduciaries. Totally unacceptable to us to provide advice and planning without being a fiduciary. So that is our requirements, and every single one of our team members meets that requirement. They're all fully trained by me as well. Hope you think that's a good thing. Okay, second piece is Einstein Retirement Workshops is an educational brand that used to be a separate entity. It is now owned and operated by City Center Financial, my firm. Okay, used to be two separate entities, not anymore. Again, full owned and operated by City Center Financial. If we get past the point in the analysis process, if you decide to get the analysis from us, we will be interacting with you virtually through a video conference phone call. This is something that we've gotten great feedback from our clients about and from many other workshop attendees like yourself. They've enjoyed that process and interacting with us in the video conference way. It doesn't matter where your location is, we can provide this analysis to you. Okay, there's something else I needed to say about that. Oh, if you get past the free stuff, okay, we've delivered all the free analysis reports, and we're now into doing planning. Here's what we do. Two ways to hire us, and the advisor that you're working with will disclose this to you up front before you would ever decide to hire us. First way you can hire us is through planning fees. $250 an hour is our typical planning fee. The amount of hours and planning services provided depends on the experience and expertise of the professional you're working with. Okay, they will disclose to you again upfront any and all costs prior to you paying for those services. And so you just want to be aware of that going in, that if you choose to engage on an hourly rate, that is available to you. Another way that our clients hire us is simply by having us manage their investment accounts. If we manage your investment account, it depends on the level of complexity as to what advisory fee would be charged. We typically run about half of the industry average at 1.5%, because we run our own investment models and strategies, our clients often will pay as little as 0.5%, and typically no more than 0.95%. Okay, so but beyond that, it depends on the level of complexity of your planning and investing strategies that we're implementing for you. Okay, but I think you'll find we to be a combination of very competitive and also something that's very fair and reasonable for you. Okay, so with that, we're going to say sendworkbook.com is the website you want to go to request your workbook and or that analysis. If you're requesting the analysis as well, we're honored by that. We're grateful to provide this to you. We're excited to provide it to you. And so you, again, just go to sendworkbook.com, either to request the workbook or the analysis or both, okay? Same website. I'm going to start taking questions also. So simply type your questions in the chat portion. I'll start highlighting them and answering those questions as we go along. But you want to go to sendworkbook.com. You can do that now and open a new browser tab. I'll still be here. You'll still be able to hear me answering questions. If you're watching on a phone and you do it on your computer or vice versa, that's all fine. But we do want to make sure we mail you that workbook. So you want to go to sendworkbook.com to do that at any time. Okay. Start answering questions. Looks like the first question here is coming from Joan. Joan says, are you a fiduciary firm or mixed? Yeah, 100% fiduciary, Joan. We do not have any non-fiduciary advisors. Every single one of our advisors is a fiduciary. Okay, Kathy says, if I file for divorce benefits, do I get my ex's full monthly benefit when he retires, or do I get a percentage of his monthly benefit? You get 50% of his, Kathy, and it's not when he retires. It doesn't matter when he retires. You get to file on your own schedule, again, so long as you've been divorced for at least 2 years. Okay, Terry's asking me to cover the windfall elimination provision. Well, this is one of the, I guess I would say, issues, Terry, with the windfall elimination provision is it's a little complicated in how it works. So the windfall elimination provision is based on the number of years of substantial earnings you have outside of your pension earning job. And so the calculation is in the workbook. So you want to just go to sendworkbook.com and get that requested. But it can't reduce it to zero. Okay, so that is one thing to remember. It can't reduce your Social Security to zero. Okay, Alice, I don't know if you're going to see this, but if I threw you back to the beginning, you can just fast forward. So hopefully you can sort that out. Okay, Kath. Oh, okay, good, Kathy. Great. Okay, again, you want to go to sendworkbook.com. Also, we do encourage you to subscribe to our YouTube channel or follow our Facebook page. It'll give you the ability to see additional workshops and events that we do. It'll allow you to get some additional information from us, and we hope that you found this to be helpful. We also hope that you'll share our channel, our podcast, share our events. Let others know if you're finding good value from us. We'd love for you to share that. That's all really helpful. Okay, Ed Chappell says, were all of your examples based on joint tax filings? Yeah, in the examples we gave today, they were based on joint, but it's the same issue, Ed. Not all the examples, okay? The ones just about how taxes are calculated, that applies to singles as well as married filing jointly, Ed. Okay, but in terms of the last example I gave, yeah, that was based on a joint tax return. But the same issue exists for a single person. Okay. Robert's saying a friend was married for 10 years. They are now divorced. She does not have her ex-husband's Social Security number and does not want to contact him. How does she file to obtain his Social Security until she reaches 70? Well, she has to be older than full retirement age by now to do that. So she may not be able to do it, Robert. But the best thing she should do is make a appointment with Social Security, and they can get her the information about whether this is going to work for her. Cheryl says, what about a person who is self-employed? Well, it depends on what part you're talking about, Cheryl. I mean, a self-employed person has the same issues as everybody else. You know, you might have a little flexibility in some of your planning needs in terms of managing your income a particular amount. But beyond that, you know, it's just the same as everybody else. Christine Fuller says, I was married for 10 years. He died at 60. I am currently married. I am 61. Will I be able to draw on his Social Security? Depends on you when you remarried, Christine. If you married after 60, then yes. If you married before 60, no. Remarried, I mean. Okay, Frank Rodriguez says, do you pay taxes immediately from receiving a Social Security check? I think for Medicare, even if I will receive medical benefit for my pension until 65. You don't. The only way to have Medicare withheld from your Social Security is to be older than 65. So if you're not 65 yet, then the answer is no. Okay, Alex is saying, okay, I don't have any other retirement for except for Social Security. I'm 61 and a half, and I'm continuing to work part-time 24 hours a week, and was planning on taking mine at 62 and continuing to work part-time. Yeah, as long as you earn less than $18,960, that would be fine. Okay, Patty's asking, is the analysis good if you will only have Social Security, since our retirement was taken in a scheme? Oh, I'm so sorry to hear that, Patty. Well, you know, it depends on what you're trying to do. You know, it's certainly not going to hurt you to get the analysis. It may not be as beneficial to you as maybe some others, but it depends on, you know, are you still trying to build up any kind of savings? Is that part potentially helpful to you? That sort of thing. Okay, Dean Anderson says, what is the difference between SSDI and SSI? So, Social Security disability income and Social Security income. Does it automatically switch when you're 65? No, it automatically switches when you hit your full retirement age. Otherwise, there's no difference. Social Security disability income is just your full retirement age amount early, so that's why it switches at your full retirement age. Okay, Dale says, do Medicare costs come into any tax calculations? Yes and no. It's not a tax in the traditional sense, but you do need to be mindful of your IRMA calculations, yeah. You're welcome, Alex. Okay, if you haven't already, go to sendworkbook.com, request your workbook. Happy to get that to you. Also want to make sure that if you're requesting the analysis, you simply check the drop down there to request the analysis, and we'd be happy to get that going for you also. Just go through that process and request that. Honored to do that for you. Okay, subscribe to our YouTube channel also. Follow our Facebook page. We'd love to interact with you at future events and future workshops. With that, we're going to wrap up today's event, and really appreciate everyone's patience with some of the technology issues we had tonight. Appreciate the time that we've had together, and I look forward to seeing you hopefully at a future event. With that, everyone have a great and wonderful night.